Your estimate going into Friday, 650,000, a median estimate so far in our survey here at Bloomberg. 266, the previous number for the month of April. That was a monster downside surprise. Still with us, BMO's Brian Belski and Academy's Peter Tchir. Pete, that's where I want to go, just to wrap up the conversation with you guys. How you're getting a read on activity in America, Pete. How do you get it?
No, I try and ignore most of the current data because I think it's still being heavily impacted by, adjustments, what we're seeing. So I'm looking, what are we expecting? How does this keep going? And I keep hearing peak growth, et cetera. I think we have a long run here that we are going to see jobs created. We're going to see more jobs. We're going to see wage pressure. We're going to see this infrastructure bill. So I'm very positive. And it's kind of, it seems awkward to dismiss current data, but really it's not telling us anything we don't already know. So it's really trying to anticipate what data is going to look like 5, 6 months down the road. I think it's going to be very, very positive, and this, engine of growth is going to continue.
Brian, would you agree with that? Would you share that view, to ignore some of the incoming data?
We would. I actually still think that the market is moving away from being macro and academic and more toward bottoms-up stocks, fundamental, building portfolios that way. Something that I learned the business back in the 80s and 90s. I think we're kind of going back to, like I like to call old-time hockey. And I think it's going to happen. And I think it's happening in portfolios already. But I think people are still concerned and they want to climb the wall of worry or whatever vernacular you want to talk about in terms of being negative. And I just think this whole inflation thing is, we've been waiting 39 years for inflation. I think we're going to wait a little bit more. Remember, the Fed, people are not talking about this enough, Jonathan. Last August at Jackson Hole, the Fed changed its mandate in terms of away from inflation and toward employment. And there's now a big academic question mark in terms of how we're measuring employment, just like how do we measure inflation. I just think that causes more confusion. And we have to focus on companies and themes and earnings. And I think that's what's going to lead the market higher.
The evidence that the approach needs to change, Brian, where are you finding that at the moment?
Well, I think you take a look at financials. You take a look at buying companies relative to ETFs and being able to maximize alpha in your portfolios. If you're owning less stocks and being more concentrated in your portfolios, they're outperforming. We have the very good opportunity. We're very blessed and fortunate to manage portfolios for a living in one of our side jobs at BMO. We run 6 portfolios in Canada and 3 in the United States. The majority are outperforming. What's really interesting is that our dividend growth methodologies in both Canada and the United States are the best performing portfolios this year, even outperforming small, mid-cap, and value portfolios in ETFs, just because we're picking stocks and sticking with a process and discipline.
You think that goes beyond just a broader recovery trade, cleaning up after what took place 12 months ago?
I do, and I think this, and like retail companies are a great example, Jonathan, right? So you had earnings in the first quarter that were rewarded, and then you had a lot of retail companies that came out and their earnings were not rewarded. And I think the problem with that, and the reason for that, is the companies that had problems before COVID are going to have problems after COVID. And it's not just because of the easy trade on a year-over-year comp base. It's because they're fundamentally flawed. So that's why we would stick with the best brands and the best run companies and be excessively thematic and fundamental in our stock picking.
Peter Tchir, final word.
Yeah, I think one thing that, if you look, one of the biggest ETFs of the year has been these ARK ETFs, right? And they are anything but passive, right? They are very actively managed. So I do believe that this is going to be more and more of a managed portfolio where you want to figure out the stocks that you want, the companies you want, and especially with this idea of sustainability driving it, you really want to identify who's going to win and who's going to attract that sort of ESG type money. And I think that's really going to be the upside in the alpha generation. So I agree that this is really a stock picker's market.